So the Federal Reserve just announced that the pivot is finally coming. And of course, interest rates are going down. Now, this has set the news off with a wave of speculation and bad takes, frankly. And everyone is pointing to history. Look, once the Fed cuts rates, the market's going to crash. But what if I told you they're all wrong? Now, real quick, if you're new here, welcome to the channel. My name is Mark Moss. I've been paying my dues, investing through 5 rate cuts with my own money. Real risk, not some academic Reddit in the books theory. Now, for the last 6 years, I've been educating investors so they can avoid many of the expensive mistakes that I had to make. Now, I've been writing a financial newsletter, I've been advising tech startups, and I'm a partner at a Tech VC Hedge Fund. And I want to get right to it. Okay, so we're gonna skip the sensational clickbait, market is going to crash narrative, and instead, I wanna focus on facts and data. So in this video, I'm gonna break down the Fed's latest move, and we're gonna look at why the markets won't crash. We're gonna look at what the hidden opportunities in all of this are, and of course, what actions you and I should be taking right now to get ready for what's about to come. So let's go. All right, let's get right into it because I got a whole lot of charts, graphs, and data to show you because, on this channel, we don't do things by intuition or wrong facts. Instead, we look at the data to see exactly what's going on. Now, of course, just to set the stage, you already know the pivot is here. We've been talking about the pivot coming for a long time. We'll get back to when we started talking about it. But of course, all eyes have been on Jerome Powell, maybe one of the most powerful people in the world because he controls the price of money of the US dollar, which of course is the reserve currency of the world. So all eyes have been on him. Every time they go into a meeting, a Fed meeting, are they going to lower rates? What are they going to say? And almost like the whole world is waiting to find out their fate based off of what this guy says. I think of it, the insanity of that, almost like seeing Punxsutawney Phil, the groundhog, come out of the ground and tell us whether spring's coming or not. I mean, that's kind of what it's like. It's pretty insane if you think about it. And of course, we've been waiting, and then sure enough, here it comes. Fed's Powell declares the time has come. Finally, we're going to pivot, going from a tightening policy to an easing policy. He talked about this at Jackson Hole, and he says that they intend to act to stave off labor market weakening. We're going to come back to that labor market weakening in a minute. But that's exactly what's happened. Now, just to kind of see this, and like I said, how long we've been talking about this, we can see that, of course, rates had been kept down at 0 since the 2020 pandemic, and then they started raising them right around January of 2022. Now, we went 17 months of raising rates, which into one of the fastest, most aggressive rate hiking, tightening cycles we've seen. And then we've been in a holding pattern since August of 2023, or about a year at this point. And so they've been on a pause. Now, a lot of people were speculating, are they going to raise rates? A lot of headlines were saying that online. I think that was insane. Of course, I've been talking about that openly. In history, there's never been a point where they paused and then started raising again, and this certainly wasn't one of them. So 17 months of increasing. We've had 12 months of a pause, which, in my opinion, is sort of almost as good as that pivot, because what it does is it assures the market that the Fed put is there. We'll come back to that. But we can see here that traders are now pricing in a 102 basis point cut, or basically a whole point of easing this year, and this kind of shows where it is. They're basically expecting in September to be 32 basis points, in November 67, and by December a whole 102. Of course, if we look at the CME FedWatch tool, which seems to be a lot more accurate, we can see that the market on there is actually giving a 65% chance of at least a half a point cut or more. So that's the odds favorite that we're going to see at least a half a point cut or more. Okay, but you already know all that. I don't need to rehash all that. What does all this mean, and what is everybody wrong about? Okay, so let's take a look at the historical look back of this, because what you see all over social media and YouTube, because they want you to click on their videos and watch them, so they want to sell you the doom, is they say, well, historically, whenever the Fed pivots, the market crashes. So it's going to be bad. Okay, does it really say that? Let's take a look. Okay, so rate cuts. As soon as the rate cuts, we have a bust in the market. Now, we're going to go through a bunch of data and a bunch of charts. I'm going to go through this pretty quickly. Okay, so the first thing is we have rate cuts, okay? So the Fed, of course, sets the price of money by making money more expensive or cheaper. And so you can see money got more expensive, cheaper, more expensive, cheaper, more expensive, cheaper, etc. Boom, bust, boom, bust, boom, bust. Now, of course, we have gray lines here. These represent recessions. So, of course, they make money too expensive, People don't buy as much money. We have a recession. They make it cheaper. The market goes up. They raise it up again. We have recession, raise it up again, and recession. That's it. Boom and bust, boom and bust. The Fed, which is supposed to stop the boom and busts, are the ones that are actually causing this. But what I want to look at is it true that every time the Fed raises rates, that the market crashes? Well, let's just take a look at this. Again, skip the headlines and the cliches, look at the real facts. We'll go back here to 2000. So we can see right here, the Fed started lowering rates at this point. The gray line shows we went into a recession. Here we have in 2007, they started lowering rates. We went into a recession. Here in 2020, of course, during the pandemic, they lowered rates and we went into a recession. Okay, so that is looking at that, but that is a recession. That is maybe a slow economic growth, but what's going on in the markets? Okay, so let's take a look at this from a factual standpoint. So let's go back here to the 2000 rate cut. Now, what I have here is the S&P 500 on the top, and what I have down here is the Fed funds rate. Okay, so what we can see is right here is where they pivoted and started to lower rates. Now, if we draw this up, what we can see is that the market had already been crashing. Now, did the market continue crashing? Yes, of course it did. It continued going all the way down to here till they were at zero. The point being is that, yes, they cut rates, but was it commonality or causality? Because the markets were already crashing down before the rate cut happened. Okay, interesting. That's in 2000. Let's go back a little bit. Let's move forward a little bit. So here we have in 2000. Now what we can see is something sort of similar. We can see right here is where they cut it in August of 2007. They started lowering Fed funds rate. And if we draw this line up, we can see again, surprise, 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 we had already been crashing. Now, let me just point out, this was the great financial crash. This was the housing market crash, if you guys remember that. And what we know is that all the way back about here in 2006, the home starts, home building, the permits were down, I think, 26 or 28%. Meaning the real crash actually started way back here. It just didn't materialize in the stock market until here. And it actually took the Fed 30 months to do anything once the housing market had already crashed off a cliff 28%. I mean, it was amazing. So again, causality or commonality. Okay, now let's take a look at this. Here we have February of 2020. Of course, I don't have to explain this one to you. This is recent history. Now we can see right here is where the Fed funds rate started to get cut. If we draw that up, that was about the peak of the market. However, I'm going to say we should throw this one aside because literally, if you can remember, I'm sure you can, the whole world, the governments of the world literally shut businesses down. Businesses that have been open for generations are now gone. I mean, people couldn't even work. So, of course, we expected a crash to happen, and it went off. So this was sort of an anomaly, but even still, it's not like the market crashed after that happened, right? This happened, the market they shut the economy down, the market started crashing, and they cut rates immediately within like a week, not 30 months like we saw in 2008, which is a key point we're going to come back to. But let's look at the other side of things. Okay, so here we have in 1995 to 2000. So what we can see here. Okay, now let's look at the other side of things, okay? So here we have a full chart of rate cuts again. And so here we have this chart where they went down, they went back up, and then they went down again right here, and we had this whole holding pattern. So they went down, but if we take a look in that whole period, we can see from 1995 until 2000, when they started cutting rates right here and went down, 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 the stock market during this time went up over 200%. So, most of the cuts didn't look like they caused the crash. It looked like they actually happened because the crash was there. And here's a case where they actually cut rates, but at the same time, the market rallied 200%. Well, let's look at another one. Here we have 2019. Now, we can see something similar. So here we have the Fed funds rate up, 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 up. We have a pause. And then here we have a cut, and a cut, and a cut. So here we have the cut. Now, if I draw the line up, what happened? Well, we can see that prices continued going up almost 60%. So we have cases where they cut, but it looked like it actually happened after the fact. And here we have cases where they clearly cut, but prices kept going up. 200%, 60%. So it almost seems like it's not a matter of does the market cause the boom or bust? It's more about the context of what they're cutting into. What does the rest of the market look like at the time of the cut? And that's the important deciding factor to determine where we're going to go. So let's take a look at that. I want to take a second just real quick to just give you a reminder. The reminder is take control of your Bitcoin. Look, for the first time in history, we have a way to preserve our property, take custody of our property and protect it with no cost. You can't do that with gold. You can't do it with your stocks. And so we can do it with Bitcoin, and you should. Now, don't store it on an app on your phone. That can get hacked. What you want to do is use a hardware device, something like this Trezor right here. So basically, your private key sits here. When you want to do a transaction, you plug it into your computer, sign the transaction. When you're done, you unplug it and put it back into your safe. I've used Trezor for now, 6-7 years because I think it's the easiest one to use. I've tried, I think, pretty much all of them. And it's also open source, so you can trust the code. And again, it's easy. Why easy? Because if it's too complex, it makes me think of how many potential holes and risks there could be, not just in the device itself, but even in my own ability to secure it. So I want something fast, I want something easy, and I want something safe. That's why I use Trezor. And if you don't use Trezor, use something. Please get your Bitcoin off the exchange. Use a hardware device to secure your private key. And if you like Trezor, check out the link down below. Okay. Why is the Fed doing this right now? We have to understand the context, okay? Well, are we in a recession? Well, technically, no, we're not. We're not in a recession. As a matter of fact, things are good on the GDP front. I have a chart right here. So we can see technically a recession would be GDP, negative GDP, and we can see that GDP is pretty flat. It's up a little bit, not good. It's not 5%, but it's not bad. We're definitely not in a technical recession for sure. So what are we really worried about? Well, we can see that it's not personal consumption and spending. So here we have a chart of personal spending. It looks like the consumer's doing pretty good, spending hanging on pretty well. But what Jerome Powell told us right here is what he's worried about is unemployment is the Fed's biggest enemy right now. Powell says he's not worried about inflation. Inflation's been coming down pretty rapidly, and they'd much rather have inflation than the opposite, which is unemployment. Why is that? Well, let's take a look at this to understand it a little bit. Now, the first thing we want to look at is it seemingly is much more dangerous. He's much more worried about unemployment than he is actually inflation. But if we take a look at the unemployment number, we can see that right here, we're sitting on pretty much like a historical low. So why so dangerous? We're like at one of the it's not like we're like up at this level, right? We're down at a historical low level right here. But here's the thing, and this is the reason why I show you all these charts and graphs. It's not the sheer number that's the problem. It's the direction and the speed that we're going. So here we have a zoomed in chart from 2019, and you can see that unemployment obviously here spiked when we shut the whole world down. But we've been basically flatlined. We got back to that normal here. But this right here is the problem. We can see that we've been on this trend line solid consistently, and right here we're starting to turn up. So it's not the number itself at a historical low. That's the problem. It's the direction that we're going. The problem for Jerome Powell and the Fed and the central planners overall is that unemployment losses are asymmetric, meaning unemployment is one of the last things that happens. Typically, a business is going to try to hang on to their business, hang on to their employees as long as they can, and firing people will be one of the last things. So it's what we call a lagging indicator and not a leading indicator. Okay, so there you have it. Unemployment is the thing they're worried about, the economy, the recession, not all those other things. And so, of course, what's the answer? Well, let's make money more cheap again. Look, here's a thought experiment. If you think about it, I talk about it in cheap money, expensive money. If you sell an iPhone, let's call it for $1,500, you sell an X amount of iPhones. If they put the iPhone on sale to $200, do you think people would buy more iPhones or would they buy less iPhones? They'd buy more because they were cheaper. So money is the same way. The price of money is the rate I have to pay to borrow it. If I have to pay 7% to borrow, it's expensive, I'll borrow less of it. If they move it down to 1% interest, I'll borrow more of it, it's cheaper. So we have cheap money. Now, why does the Fed lower and raise and lower the price of money, of course, to stimulate growth. If they lower the price of money, more people borrow. That means businesses expand, they buy more equipment, they buy more trucks, they hire more people, more homes get built, more homes get purchased. So they use it to stimulate growth when we have that cheaper money. Now, once we have cheaper money, that stimulates the growth, businesses do better, people have more money, maybe people can refinance their homes down, then we have more discretionary spending. So now all our money doesn't go to fixed expenses, we can spend on other things. Again, we can build up businesses, we can spend more money, which then means those businesses do better, which then means their stock prices go up, which then means asset prices go up. Obviously, you get all this. It's the boom that we're talking about, and that's what is happening. Now, can the Fed save us this time? Well, I already showed you the historical facts, but let's talk about why I think, dare I say, this time is different. Dare I think that the Fed can save it? Well, the Fed has been reloading the cannon, the money printers, reloading, as I said, reloading the ink in the money printers, if you will. So you have to realize that right now we have all the markets, basically, S&P 500, the NASDAQ, Bitcoin, gold, everything's at all-time highs. Right now, after the Fed has been on the fastest and most aggressive hiking cycle we've seen in history. There's been no stimulus. They've been tightening. They've been reducing their reserve balance sheet, and yet we're at all-time highs with no stimulus. Now, what we can see is that there's lots of room for them to go. They're rested up. They're reloaded. Now, what we can see right here is this is 2004 going into 2007, 2008, into the great financial crash. We got to zero. So we're at 0% rates. And then, of course, we went up into 2019, came back down to zero. And again, this fast rate hiking cycle. What we can see here is that we're all the way back up to where we were in the 90s. In the mid-2000s. That's how high we are. What that means is the Fed bought themselves all this room. They could easily cut down a couple points and end up right here and not even be that crazy low historically. Nowhere even near to zero, and they've bought themselves all this room. They've got themselves all these tools. They've rested up, if you will. In addition, what they've been doing is they've been rolling off their balance sheet. So you can see right here was in 2020 when they put all the stimulus onto the books to get the economy going again. And that went up like crazy, but they brought it all the way back down right here. So they freed up all this room. So that's like restocking the ammo in their cabinet, if you will. So they have all this capacity that they've freed up. They have all this interest rate capacity that they freed up, and they're ready to go. They're rested, and they're ready to run, to do whatever it takes to keep this economy going. Jerome Powell said it himself in a 60 Minutes interview. I played the clips on this channel before. He said, look, we would rather go too far, meaning hold rates higher for longer. We'd rather go too far than pivot early, because inflation, we want to get inflation under control. He said we'd rather go too far and break things because we have the tools to rebuild them. That was his quote. And this is exactly what we're seeing. So they have all the tools they need to keep this system going. Now, the other reason why this thing is about to blow off like a powder keg is because not just the Fed has been resting, but you and I have been resting. Businesses, investors, we've all been resting. There's a lot of money that's been sitting there sleeping on a pillow ready to go. What do I mean by that? Well, because rates were so high, 5% plus, a lot of people, even like myself, took a large amount of cash out of the markets and moved it into Fed funds, treasuries, money market accounts, and earn 5% plus. Why would I take the risk in the S&P 500 to make 7, 8% when I'm guaranteed 5 or 6% over here? And that's what everybody did. So all that money came off. However, when the rates come back down, it's no longer as attractive as it used to be. Now we can see this evidence again in the charts. We like to look at the data. So we can see this is money sitting in money market accounts. So money put into account to earn that treasury yield. And we can see it was basically zero up to 1980. I mean, look at that flat line. And it inched up. Here in 2000, rates went up. It started attracting some money. Here's 2008. Money ran to safety and it went in there. But look where we're at right here. We have almost $6.5 trillion, $6.44 trillion that's sitting on the sidelines because the sidelines is the most, or has been, the most attractive place to be. However, when rates come back down and asset prices start running, where do you think that resting money goes? Would I rather make 2.5% or 3% over here when Bitcoin's running at 100, 150%, when gold's running, when the S&P 500 is running, when real estate's running? No, I'm going to take that money, the 6.5 trillion out of here, and I'm going to deploy it into assets. And then what happens? Well, those assets go up even faster and faster. Okay, now the old cliche, it's different this time. Why is it different this time? Well, I've laid out a bunch of reasons. Let me give you a couple more. One of the reasons why is 2008 quantitative easing. I talk about this all the time. I've done entire videos on this, that most of the data we look at pre-2008 doesn't really apply as much as the times that we're in today, because everything changed in 2008 when we got quantitative easing. So quantitative easing was something new in the United States, sort of new for the world. And you can see the Fed balance sheet had been basically flat, and then they pumped it up with all the stimulus to try to get the markets going. And this balance sheet has been growing ever since. There's a couple things with this. Number one, they've gotten pretty good at QE. Now, I talked about how in 2007 it took 30 months to get any type of a bailout going. As a matter of fact, when Bear Stearns went down, which is widely accepted as sort of that trigger point that brought the entire global financial system down, cascading down after that, it took 7 months to organize a bailout. So when the bank that took all the other banks down with it, it took 7 months to get a bailout. But here in 2023, when we had the 3 banks, Silicon Valley Bank, First Trust, et cetera, when they went down, it took, I think, 6 days. So we went from 7 months to get a bailout over here to 6 days. So the QE changed a couple things. Changed, number one, how the central banks and governments interact in the markets, number one. Number two, it changed their willingness to even intervene. Again, 30 months or 7 months here to 6 days over here. But more importantly, what it did is it over-levered the system. The more the system gets levered up, the less it can withstand any type of drawdown. So what we saw in 2000 or in 2008 isn't really possible to happen again. And so that's why this time is different. As I quote all the time Einstein, he said, the answers changed. Okay, now what's going to happen? What do we do to prepare for this? Well, what we want to be prepared for is an asset boom. Okay, I think that over the next 12 months, things are going to be explosive. Why? Well, this comes down to something I call the monetary codex. I've done a bunch of videos on this as well. And it basically maps the liquidity flows. So liquidity, the money, moves asset prices, and it goes in cycles like this. And we have about 12 more months in this cycle, probably maybe up to 15 months, before we start to see the next downturn and the next problem. So in all of the things that I've shown you, the pivot, the cheaper money, the money coming off the sidelines, the next 12 months, 12 to 15 months, I expect this to be explosive. Where will it go? A couple sectors I think will do really good. Real estate I think could do really well. Now, not just single family, bread and butter, 3.2 or 3 bedroom, 2 baths, but specifically I like multifamily. Why? Because multifamily is purchased for cash flow and you price it off of a cap rate. So a cap rate is a multiple of the net operating income to the value price. Now, when you bring the cost of the debt service down, that means that the valuation of the building goes up. Because rates went up so fast, it hurt the valuation of those buildings. But if rates go down, it brings the valuation of those buildings back up. I like multifamily real estate. I like the leverage that it provides. I like the tax incentive that it provides. Tech stocks. Tech stocks have been sort of, well, they're still holding up. The Mag 7's been holding up pretty good. But when money is cheaper, then we have to chase more yield, and it will go into more risk assets, tech stocks. Of course, this falls in line. Bitcoin and tech stocks fall in line with my Q wave, my quantitative wave thesis. This is where all the money is going to be made in the next 12 to 15 months. Basically, the intersection of what I call Bitcoin 2.0 plus AI. So I really like that. And of course, gold is breaking out in almost every currency across the world. We can see that gold is telling us something big is happening, and it's breaking out. It's not going to be anywhere near explosive as these two. Maybe more in line with real estate, but real estate has other things. But that is where I'm looking to put my money. Now, if you want to know more about this Q wave and this sector to invest into, I got a video right here. You can go ahead and click and watch that if you want. But let me know what you think about this. Is this time going to be different, or am I wrong and history is somehow going to repeat? Let me know in the comments down below. If you like this video, give me a thumbs up. If you don't, you can give me a thumbs down. That's okay. But at least tell me why in the comments, and that's what I got. All right, to your success. I'm out.